The income statement of Hapag-Lloyd over the 2023-2025 period tells a story of normalization from the record-shattering profits of 2022, followed by a stabilization at levels significantly higher than pre-2020 averages, despite severe operational headwinds. In the 2024 financial year, Hapag-Lloyd achieved a group EBITDA of $5.0 billion, a slight improvement over the $4.8 billion recorded in 2023. This was achieved despite an average freight rate of $1,492 per TEU, which was virtually unchanged from the prior year's level of $1,500. The growth engine in 2024 was volume-based, as transport volumes rose by 5% to 12.5 million TEU, reflecting resilient global demand for containerized goods, even as supply chains were rerouted away from the Red Sea. As the industry entered 2025, the revenue dynamics became increasingly tethered to geopolitical flare-ups and trade policy shifts. For the first 9 months, 9M, of 2025, group revenue reached $16.05 billion, representing a 5% increase from $15.28 billion in the same period of 2024. However, this top-line growth masks a decoupling between volume and price. While transport volumes surged by 9.1% to 10.17 million TEU in 9M 2025, the average freight rate fell to $1,397 per TEU, a 4.8% decrease from $1,467 in the previous year. This downward pressure on rates suggests that the massive influx of new vessel capacity is beginning to outweigh the capacity-absorbing effects of longer routes around the Cape of Good Hope. The decline in EBIT and EBITDA margins is a critical signal for investors. The narrowing gap between revenue and operating profit reflects a combination of falling rates and escalating congestion-related costs and network transition costs associated with the launch of the Gemini cooperation. The 9M 2025 EBIT margin of 6% is a sharp contraction from the 13% seen in 2024.
Hapag-Lloyd's cost base has been profoundly impacted by the necessity of rerouting vessels around Africa. Rerouting adds approximately 10 days to a voyage and increases fuel consumption significantly. In the first half of 2025, bunker consumption rose by 7.6% to 2.5 million metric tons. However, a favorable decline in the average bunker price from $601 per ton in H1 2024 to $542 in H1 2025 partially offset the increased volume, resulting in bunker expenses of €1.23 billion, a slight decrease year-on-year. This operational benefit was countered by the rising costs of environmental compliance. EU Emissions Trading System (ETS) costs rose from €42.9 million to €67.7 million in H1 2025, a trend that is expected to accelerate as regulatory frameworks tighten. Hapag-Lloyd's transition toward more fuel-efficient vessels is thus not just an environmental goal, but a core financial necessity to mitigate green inflation in maritime logistics. In 2023, Hapag-Lloyd made the strategic decision to separate its business into 2 reporting segments, liner shipping and terminal and infrastructure. This segmentation allows for a clearer evaluation of the company's Pure Play Plus strategy, which aims to diversify earnings away from the volatile ocean freight market. Hapag-Lloyd maintains one of the strongest balance sheets in the global shipping industry, a factor that provides it with significant strategic optionality during market downturns. As of September 30, 2025, the group's equity ratio remained robust at 61.0%, virtually unchanged from the 61.6% recorded at the end of 2024.
The primary assets on Hapag-Lloyd's balance sheet are its container ships and container equipment. As of mid-2025, the fleet consisted of 313 vessels with a capacity of 2.5 million TEU. A critical trend is the company's shift toward owning more of its capacity. By late 2025, 60% of the fleet by TEU capacity was owned, up from 58% at the end of 2024. This increased ownership reduces exposure to the volatile time charter market, where rates have remained elevated due to the Red Sea crisis. The transition from a net liquidity position of $946 million at the start of 2025 to a net debt position of $665 million by September 30, 2025 is primarily attributable to large-scale capital expenditures for fleet modernization and the substantial dividend payout of €8.20 per share in Q2 2025. For an industry as capital-intensive as shipping, maintaining a debt-to-equity ratio of 0.35 is exceptionally conservative, especially when compared to ZIM, whose debt-to-equity ratio stands at 1.41. Hapag-Lloyd's order book is a key forward-looking element of its balance sheet. As of September 2025, the company had 24 new builds on order with a total capacity of 312 TTEU, scheduled for delivery through 2029. These include ultra-large 24,000 TEU dual-fuel vessels that are significantly more efficient than the older fleet. The company also recently decided to invest in up to 22 smaller ships under 5,000 TEU to optimize its feeder and regional networks, further reducing its reliance on expensive short-term charters. The cash flow profile of Hapag-Lloyd reflects the high capital intensity, cyclical nature of the business, but with a recent focus on high payout ratios. Operating cash flow for 9M 2025 was $1,403 million, a decline from the $1,661 million recorded in the same period of 2024. Despite this decline, free cash flow, FCF, remained positive at $1.4 billion, Euro 1.26 billion.
Hapag-Lloyd has positioned itself as an attractive dividend stock in the DAX and global shipping sector. The payout for the 2024 financial year, paid in 2025, of €8.20 per share represented a total payout of approximately $1.5 billion. While this is lower than the massive €63 payout in 2022 and €9.25 in 2023, it remains high relative to current earnings, resulting in a payout ratio close to 94% on a TTM basis. The sustainability of such high payouts is a point of debate. Cash flow from operations in 2024 was $4.37 billion, $4.73 billion, while investments in the vessel and container fleet reached $2.2 billion. As long as FCF remains positive and the company maintains its high equity ratio, it can afford to return significant capital to shareholders. However, the move into a net debt position in 2025 suggests that the management is now balancing aggressive dividends with the need to fund its Strategy 2030 targets. Valuing Hapag-Lloyd requires a nuanced understanding of the Hapag premium. Historically, Hapag-Lloyd has traded at higher valuation multiples than its peers, such as AP Moller-Maersk or COSCO Shipping Holdings, due to its superior balance sheet, pure-play focus on container shipping, and generous dividend policy. As of early 2026, Hapag-Lloyd's trailing PE ratio is approximately 14.2x, significantly higher than Maersk, 7.1x, or ZIM, 2.6x. This discrepancy is largely due to Hapag-Lloyd's status as a pure-play ocean carrier without the conglomerate risks of Maersk and its much stronger financial stability compared to ZIM.
Key valuation comparisons. Trailing PE ratio. Hapag-Lloyd stands at 14.16, which is higher than Maersk, 7.09, ZIM, 2.57, and COSCO, 3.10. Price per book, PB. Hapag-Lloyd is valued at 1.2x, a premium over Maersk, 0.6x, ZIM, 0.4x, and COSCO, 1.0x. Price per sales, PS. Hapag-Lloyd is at 1.14, compared to Maersk, 0.63, ZIM, 0.34, and COSCO, 0.59. Analysts have a wide range of price targets, with the 52-week range for the stock being Euro 108.3 to Euro 174.6. The current enterprise value, EV, stands at approximately $26.0 billion, with 2025 EV/revenue estimated at 1.3x. The consensus forward earnings are under pressure due to the projected slowdown in global trade and the oversupply of vessels. Global container volume growth is expected to slow from 3% in 2025 to just 2% in 2026, while the order book represents over 30% of current fleet capacity. This suggests that the high PE multiples may be vulnerable if the normalization of freight rates overshoots to the downside. Hapag-Lloyd's future performance is inextricably linked to two major factors: the resolution of the Red Sea crisis and the long-term success of the Gemini cooperation with Maersk. The launch of the Gemini cooperation on February 1, 2025, represents a departure from the traditional alliances. Gemini focuses on a hub-and-spoke network that leverages Hapag-Lloyd's terminal holdings to ensure industry-leading schedule reliability of 90%. This model is designed to optimize vessel utilization and reduce blank sailings, which are often the primary cause of customer dissatisfaction and increased logistics costs. If Gemini can consistently deliver 90% reliability while competitors average 60 to 70%, Hapag-Lloyd will be able to secure long-term contracts at premium rates, insulating itself from the spot market's volatility.
The ongoing security situation in the Red Sea has acted as a capacity sink, artificially propping up freight rates by forcing a significant portion of the world fleet to take the longer route around the Cape of Good Hope. Hapag-Lloyd has noted that this situation enabled it to keep customer supply chains intact, but at a significant operational cost. A sudden resolution of the conflict would likely lead to a capacity glut as ships return to the Suez Canal, potentially causing rates to plunge. Simultaneously, the U.S.-China trade relationship is reshaping global shipping flows. U.S. imports from China fell by 28% year-over-year in 2025 due to aggressive tariff policies. Hapag-Lloyd has responded by pivoting towards Southeast Asian markets like Indonesia and Thailand, which have seen growth of 34% and 28% respectively. This nearshoring and sourcing diversification are core components of Hapag-Lloyd's strategy to mitigate geopolitical risk. The bear case for Hapag-Lloyd focuses on the unavoidable cyclicality of the shipping industry and the risk that the company's operational improvements will be overwhelmed by external macro forces. The global vessel order book is the single largest threat to the industry. At 10.3 million TEU, it represents 31% of the current world fleet. While the Red Sea rerouting is currently absorbing much of this capacity, a resolution of the conflict would immediately flood the market with excess tonnage. This would trigger a destructive freight rate war as carriers prioritize filling their ships over maintaining price levels.
A broader escalation of U.S.-China trade tensions or the implementation of new, aggressive global tariffs could lead to a permanent contraction in world trade volumes. Container shipping is fundamentally a play on global GDP and trade growth. If deglobalization accelerates, even a high-quality carrier like Hapag-Lloyd will see its transport volumes decline and its expensive ultra-large vessels become underutilized. While Hapag-Lloyd is investing in fuel-efficient ships, the absolute cost of green transition is enormous. The price of green methanol and other alternative fuels is significantly higher than traditional bunker oil. If the industry cannot successfully pass these costs on to shippers through surcharges, Hapag-Lloyd will face a long-term margin squeeze where higher operating expenses meet lower freight rates. Hapag-Lloyd has a very low free float, approximately 3.3%, with the majority of shares held by a few large entities. This low liquidity can lead to share price volatility and makes it difficult for institutional investors to enter or exit positions without moving the market. Furthermore, the company's strategic direction is heavily influenced by these major stakeholders who may prioritize the needs of their other holdings over the independent interests of Hapag-Lloyd's minority shareholders.
The bull case for Hapag-Lloyd rests on the company's ability to successfully decouple from the commodity shipping market and establish itself as a specialized service provider with operational control. Through the Gemini cooperation, Hapag-Lloyd is setting a new industry standard for schedule reliability. In an era of just-in-time manufacturing and high inventory costs, shippers are increasingly willing to pay a premium for predictability. If Hapag-Lloyd can consistently hit its 90% reliability target, it will capture a larger share of high-margin reefer and sensitive cargo segments, leading to higher average revenue per TEU than its competitors. The aggressive expansion into terminals, Hanseatic Global Terminals, provides a strategic moat. Owning terminal capacity in key hubs like Le Havre and Damietta ensures that Hapag-Lloyd vessels receive priority berthing, reducing idle time and fuel consumption. This vertical integration also captures the profit margins of terminal operations, providing a stable earnings floor during periods when ocean freight rates are depressed. Hapag-Lloyd's 61% equity ratio and conservative net debt of USD $665 million as of 9M 2025 provided with the financial ability to survive a prolonged industry downturn or pursue opportunistic M&A. The company can sustain its attractive dividend policy longer than more leveraged peers like ZIM, making it a flight-to-quality stock in a volatile maritime sector.